A very good evening to all of you, to the special speaker for the day, CAP Shankar Raman, and to all the members who have gathered here. Today is a very interesting topic. We are going to the series 2 of the standards on auditing. Standards of auditing is very important for all of us, and today's topic is going to be a very engaging one because it is about SA 210, which is about audit engagements. We are going further on to other topics, and I'm sure that it is going to be a interactive session because we have lots of doubts on various aspects relating to engagements, relating to engagements, quality control, and issues relating to the financial statements and SEC. I don't want to dwell more on it, but before that, I would like to introduce CAP Shankar Raman sir and hand over the dais to him. So we know that Shankar Raman sir doesn't need to be introduced with 27 years of post-qualification experience, and he is the partner in Suresh Surana and Associates LLP. So prior to this, he has also been partner in various other, including Deloitte, Haskins, and Sells, and he has led and coordinated various large and multinational audit engagements. So basically, his specialization is financial services sector, manufacturing, power, retail, and distribution, and consumer business. And he also has managed, which is very special actually. He has managed initial public offerings, which again requires a lot of statutory compliances, performing financial due diligences and internal audits. He has hands-on experience on GAAP, Ind AS, IFRS, and US GAAP. So he has virtually gone global. He has done audits under auditing standards generally applicable in India, international auditing standards, US GAPs, and PCA OB standards. So with this brief introduction, I hand over the mic to CAP Shankar Raman to carry on with today's discussion on beginning with audit engagements. Thank you so much.
Okay, thanks ma'am for your kind introduction, and good evening audience. Hope you are able to hear me and see me properly, and hope you are able to see my screen.
Yes, sir. Visible, sir.
And you are able to see my screen moving, right?
Yes,
okay.
Sir. Yes, we can continue, sir.
Okay, thanks a lot, sir. So good evening, everyone. So I'll be dealing with 4 auditing standards as suggested by Madam. We will start the discussion with SA 210. SA 210 talks about agreeing the terms of audit engagements. This standard is effective for accounting periods beginning or after 1st April 2010. So we know the standard in our usual colloquial term, we call it as an engagement letter. We as professionals in audit and assurance and other services know the importance and why an engagement letter is required. So we all understand that the terms of an engagement needs to be put in writing and agreed with the client so that there is a clarity. So this standard would basically deal with certain aspects on agreeing the terms of engagement. So we will dwell upon in slightly a detailed manner what the standard is about, what would be the auditor's responsibility, what does an auditor enter into when he signs off an engagement letter, and we will also consider certain precautions that we need to consider as an auditor before getting into an engagement letter. So before we get into any engagement, be an audit or be it limited review or be it due diligence, we assume that there are certain preconditions available. So we go with an assumption that certain things would be available in the manner we require it to happen. So it is based on this premise, it is based on this understanding that the preconditions are present, we build upon the entire audit process. And why is this terms of engagement required to be entered into with the client? There needs to be a common understanding between the auditor and the management. So when I say preconditions, what are those preconditions? One, we need to have clarity in terms of what would be the financial reporting framework which is used in the preparation of the financial statements, whether it's an IGAP, whether it's an Ind AS, whether it's an IFRS, or whether it is going to be some generally accepted accounting principles which is selected by the management. Two, we also understand these important aspects by an agreement with the management or with those charged with the governance. So the engagement letter or the terms of reference would be agreed with the management or those charged with governance. So when you say preconditions for an audit, there are two aspects as I discussed. One would be the reporting framework. So whether it's an IGAP or an Ind AS, as I spoke to you. And we also have an understanding and obtain an acknowledgement of the management as to three major responsibilities. So what are those things which the management is responsible to? One, they will prepare the financial statements in accordance with the financial reporting framework which has been agreed upon. Two, there exists an internal control within the organization to ensure that there is no material misstatement in the financial statements. And three, the management will provide with the auditor an unrestricted access to the employees to obtain all audit evidence. They will provide us with all the relevant information. They will also provide us with any additional information as and when requested. So when I started the discussion by stating that the preconditions are to be there, these are the preconditions which we presume would be there before we get into any terms of engagement. The financial reporting framework, the presence of internal control, and an unrestricted access to people and information so that we can perform our duties and responsibilities. So what if any of the preconditions is not there? For example, if the management is not clear in terms of what would be the financial reporting framework, or the management says that, no, I will not allow you to speak to any of my employees. I will just get the data, give you the data. So based on the data, you have to do the audit. So in case if the preconditions, which we assume are not going to be present, we need to have a discussion with the management, because just as a hypothetical example, if they say I cannot talk to any of them, it will be very difficult for us as auditors to perform our duties and responsibilities. We will not be able to get the necessary information, which would be the basis on which we reach the conclusion on the audit engagement. So we need to have a discussion with management as to why they are going to prevent us from having a discussion with the people, or why they are going to say that certain information will not be provided to us. But even in such cases where certain preconditions are not present, but based on certain regulations, if the auditor is forced to accept the engagement, then we need to handle certain precautionary requirements before doing so. Under most circumstances, what I have practically seen is that in case if based on the initial discussions, if we understand that the preconditions are not present, we generally work out without even accepting the engagement, because we know for sure that because of this scope restrictions, we will not be able to perform our duties and responsibilities and give the audit opinion in the manner required by the various auditing standards. In case if there is a limitation in scope, then we need to think twice before we accept the audit. Say, for example, if the client comes to you in June and asks you to do an audit for March 22 financial statements, you find out that the inventories is very significant portion of the current assets of the company. But you will not be able to do a physical verification on 31/3 because the appointment itself is having only today. So is this an important scope restriction? Is not observing the physical inventories on the balance sheet date going to result in a scope restriction based on which I will not be able to perform my duties, or I will not be able to give the opinion in the manner required? So in such cases, should I accept the engagement or not? This will be the question that you will have to debate before you get into the terms of agreement. In case if there is certain law or regulation which mandates to accept you, then you don't have a choice. But in case if there is no mandatory requirement from any of the laws, then you need to think twice before you accept an engagement. So when I say agreeing the terms of audit engagements, what do I do? So we all have entered into engagement letters, and we all know that what would be the basic contents of the engagement. Generally, the practice is that we get into an engagement letter after we are appointed in the AGM or after the AGM happens. Now, as we all understand that even the ratification of appointment of auditors is not required, and we are getting appointed for 5 years. Generally, we cover all the services, say statutory audit, ICFR opinion, the certificates that we mandatorily need to be issued only by the statutory auditor. In case if it is a listed company, the quarterly limited reviews as required by SEBI. In case if the company has any subsidiaries or associates, the requirement of consolidated financial statements. So these are the various aspects in terms of the scope of work that we include in the audit engagement letter. So what will be the major contents of an audit engagement letter? We give the objective, we give the scope of audit, we define what is auditor's responsibilities, we define what is management's responsibilities, we define what is the financial reporting framework, what would be the kind of report that we would be giving in, and what would be the contents of the report that we expect to give after completion of the audit. In case, again, if it is going to be a listed company, our responsibilities under 701 on communicating key audit matters. There will be inherent limitations in the audit. So because of these inherent limitations, we will not be able to identify and find out all material misstatements. So there is a risk that there could be a material misstatement which we would not be able to detect, in spite of performing the audit in the manner which is suggested by the various auditing standards. So this would be another clause which would be listed down in the audit engagement letter. We also discuss about the nature of audit, the timing, the composition of the engagement team. We tell the management that you will have to provide audit management representation letters. We make the management responsible to say they should provide us with the draft financial statements and other accompanying information on a timely basis so that we can do our audit within the timeline. We also make the management responsible for making us aware of any subsequent events from the date of balance sheet till the date of sign off, because we need to comply with the requirements of the auditing standard for subsequent events. We speak about the billing arrangements. We speak about other responsibilities, saying that our financial work papers would be subject to peer review of the ICAI. In case of listed companies, there are certain obligations of the auditors in case of resignation of auditors. So the engagement letter should talk about what would be the responsibilities of the auditors in case we end up in a situation wherein we are resigning even before the year-end audit. So these are certain important aspects which would be covered in the audit engagement letter. So this is just this simple example of a typical audit engagement letter, just summarizing the discussion we had. So we speak about the financial year. We speak about that this is audit as per the Companies Act. We give the objective, expressing of an opinion to say it is whether true and fair view, and we comment on the financial performance, the financial position, and the cash flow statements of the company. We define what are all the responsibilities. We will conduct the audit as per the auditing standards. We will ensure compliance with the ethical standard. We will plan and perform the audit. We give only a reasonable assurance. We don't give an absolute assurance. We speak about getting audit evidences. We speak about audit judgments. We speak about management estimates. We speak about the accounting policies to be used. And we also speak about the kind of report that we will be given, which would be basically a reference to the requirements of SA 700 and other standards. We also list down the management responsibilities, wherein we say they are responsible for ensuring compliance with the Companies Act, maintenance of books of accounts, preparing the accounts on a going concern basis, ensuring compliance with the various accounting standards, selection of accounting policies and ensuring that it is consistent with previous years, their responsibility to ensure that the assets are being safeguarded, their responsibility to bring in internal controls, their responsibilities to ensure compliance of applicable laws. I will talk about applicable laws when I deal with SA 250. So these are some of the typical clauses that you see in any audit engagement letter. And this is basically an extract as given in the standard and also a practical example that we have used in some of the engagements. Okay, so as I said, preconditions is very important. We need to have an agreement on the terms of engagement. And generally, this agreement happens in writing. So in case if there is any specific law or regulation which would define these things, if the law states that the preconditions will be present and this would be the auditor's responsibility, this will be the management responsibility, then we can probably refer to that particular law instead of elaborating the terms of that law again. This is allowed as per the standard. So in case if the responsibilities are similar as defined in the law as compared to 210, again the responsibilities can also be cross-referred to the law rather than explaining it. But in case if it is not available in the law, then we as an auditor need to ensure that the responsibilities of both the auditors and the management is spelled out very clearly in the audit engagement letter. One of the questions which generally crops up when we discuss the audit engagement letter is the audit engagement letter required to be signed every year? Because as we all know, under the Companies Act, the appointment is given for a term of 5 years. And even as per the amendment to the Companies Act, the reappointment formalities need not be done in every annual general meeting. So it is by default that we get reappointed. There is no rectification required at every annual general meeting. So the question that comes up is, would an engagement letter need to be signed every year, or can we give an engagement letter only in year 1 and say that that would be valid for all the 5 years? The standard as well as the implementation guide to the standard talks about certain circumstances in which we need to revise the terms of engagement on a yearly basis or in a particular frequency as and when there are certain indicators as listed down here. So what are those circumstances in which we may need to require to reissue the engagement letter and get it signed off by the management? In case if we feel that there is any misunderstanding of the objective and scope of the audit, in case if there is any revision required, in case if there is any specific terms to be added. Say, for example, we have issued an audit engagement letter. Then SEBI came out with a requirement to state that these are all certain clauses which should be there in the engagement letter of the listed company or its material subsidiaries as it deals with a resignation of the statutory auditors. So in those cases, we were required to reissue the engagement letter, including those clauses which has been suggested by SEBI. So in case if there is any recent change in the senior management of the company, or in case if there is any change in the ownership, or in case if there is any change in the nature of business, the size of the business or its operations. If there is any change in the regulatory requirements, say for example, out of the 5 years you were appointed, the company was adopting IGAP for the first 2 years. It's an unlisted company, for example. But in the 3rd year, the net worth has crossed to 50 crores. So you may need to do the financial reporting framework under Ind AS. So in this case, there is a change in the financial reporting framework. So under this circumstance, you will have to reissue the engagement letter because the basis of financial reporting framework, which was IGAP earlier, has now got converted into Ind AS. So which is a significant change. As we started the discussion, the financial reporting framework is one of the preconditions for the audit. So in such cases, I cannot go and say, no, I've already issued the engagement letter and that will stay. So this will be a circumstance wherein we may need to reissue the engagement letter. If there is any changing the reporting requirements also, we have to reissue the engagement letter. So though there is a practice that an engagement letter can be valid for more than a year, in case if you come across any of these situations, again, these are only examples. This is not an all-inclusive list. So you may have to have your professional judgment to see whether any of the circumstances that you might come across in your audit engagement might result in reissue of the engagement letter. But these are certain examples which would probably guide you in coming to the decision. During the course of the performance of audit, there could be circumstances wherein there could be a change in terms of audit engagement. The management can come and have a discussion on any specific changes that they may require. So in such case, where there is a requirement from the management to make any changes, what would be the auditor's responsibilities? One, we cannot straight away agree the change. We need to have an understanding from the management. We need to have a justification by the management on why they want a change in scope. The second aspect that we need to consider is that the changes in scope should not result in a lower level of assurance. Say, for example, if we were appointed to do an audit of an unlisted company. Now they come and say, no, I don't want an audit, you just give me a limited review. As we all know, audit gives some audit assurance, and limited review, as the term suggests, it gives you only a limited assurance or only a negative assurance. So there is a reduction in terms of a level of assurance you give. So unless you have a reasonable justification, you will not be able to accept it. In case if you accept for the changes, then the revised terms and conditions should be agreed by a new engagement letter or in any other written format, so that there is a clarity. In case if you are not able to agree for the revised scope and the management is also not willing to go with the original scope and they insist that the scope has to be revised, then you may also need to consider whether you will have to withdraw from the audit engagement. So there could be circumstances in the audit while you perform before you issue the report on certain changes suggested by the management on the terms of the audit engagement. And these would be certain precautions that you as an auditor needs to take before you accept or reject the same. So compliance of law is very important for us as an auditor. So in case if there is going to be any conflict between the financial reporting framework chosen by the management and the particular law, again we need to have a discussion with the management as to how you are going to deal with it, whether you will have to make any additional disclosures into the financial statements, or whether there can be a change in the financial reporting framework so that you can comply with the regulatory requirements. So these two things goes hand in hand. We have the financial reporting framework, you will have the law and regulations. So these needs, both of the things has to be complied. So in case if you see any differences, you will have to be very clear in terms of how you deal with it, how you discuss it with the management, and these are also important aspects which should be forming part of the terms of audit engagement. So in addition to compliance of laws, there could also be other matters which could probably affect your audit acceptance. So again, you need to be very clear as to whether there could be any other aspect which, if not considered for reporting, could result in a misleading of the reporting of the financial statements, and thereby the financial statements may not be suitable for the purposes of the inherent users. So again, in such cases, you need to have these aspects included as part of the terms of engagement. So since the standard talks about having a clarity on the terms of audit engagement, the standard also talks about various circumstances on which there could be a lack of clarity between you and the management. So all those aspects wherein there could be a lack of clarity, the standard provides for a list of things that you need to do as auditors. Understand, see the financial statement framework, see the laws and regulations, discuss with the management, if required, discuss with those charged with governance, see how you can deal with it, see whether it would involve additional procedures, whether it should involve additional documentation, whether that would involve additional disclosures, and whatever understanding you have with the management, you ensure that it is being put in writing so that there is an absolute clarity between you and the management in terms of what you will be doing, how you will be proceeding, and what you would be reporting, and how you will be reporting. See, under normal circumstances, when the financial framework is clear, the preconditions are present, then the engagement letter could be simple. But the more complications which are created by either change in scope or change in circumstances or difference between the financial reporting framework and the laws and regulations, we need to be very clear in terms of how you document it in your engagement letter and get it to the attention and sign off by the management. Because ultimately, the financial statements will be used by various stakeholders, and they should have a clarity in terms of what kind of assurance you give on the financial statement, and there cannot be any kind of misunderstanding that could possibly result because of these differences which could be there during the course of the audit. So this is a nutshell about the standard SA 210. To summarize, this standard talks about audit engagement letter. The preference would be is to have the audit engagement letter in writing. This should be generally given every year, but there could be certain circumstances wherein you may say that the same engagement letter would be used for subsequent years also. But we spoke about certain circumstances, and if there are such circumstances which is there as part of the audit, you may need to reissue the engagement letter. Preconditions, very important. You need to have a discussion and ensure that those preconditions are there. In case if it is not there, it could also result in a situation wherein you will not be able to accept the audit. There could be changes which happen during the course of the audit, and we discussed what would be the precautions that we have to take care of it. And we also spoke about circumstances wherein there could be differences between the financial reporting framework and the laws and regulations. And we spoke about how the auditor should approach those cases, including making it very clear in the audit engagement letter of the understanding we have. Because ultimately, you and the management should be very clear in terms of what is being done, and there should not be any absence of clarity. To facilitate we as professionals ensuring compliance of SA 210, the ICAI has also come out with an implementation guide. The implementation guide in nutshell talks about the background of the standard, which would be basically the summarization of whatever we have discussed now. It has FAQs. I think it has at least 25 to 30 FAQs. The FAQs deals with various aspects, right from to whom you have to address the engagement letter, who should sign the engagement letter from your side, who should sign the engagement letter from the client side, what should be the date, what should be the contents of the engagement letter, what should be the precautions or additional aspects that you need to cover in the engagement letter in case if it is a joint audit. So there are various FAQs. So wherever you have any doubts in terms of what you need to do, the implementation guide of ICAI could be the first referral point that you can use. In addition to giving FAQs and the background, the implementation guide also provides you with some illustrative wordings. Say, for example, if it is Ind AS, the financial statements itself would change because we know that it would include the SOC, the statement of changes in equity. So the definition of financial statements in the first paragraph would undergo a change. So like we discussed even during the circumstances, there could be a peer review. We have hidden responsibilities as per the ICAI requirements. So on all these specific clauses, the implementation guide also provides you with the illustrative wordings that you can use. The standard provides you with the standard engagement letter template, and the implementation guide provides you with some additional wordings which we as professionals can consider when drafting the engagement letter based on the circumstances that you come across the audit. So this is in nutshell about SA 210. So we can go So what I was told by the organizers of the institute is that we can take up the questions at the end. So let me complete all the 4 standards and have about 15-20 minutes at the end so that any comments and any remarks that you people have or any of the discussions that you had, we can have a discussion. The next standard we will be dealing with is SA220. A very small standard, but very important standard. The standard deals with quality control for an audit of financial statements. Anything we do, it should ensure the quality is present. We know the atmosphere in which we are now living. There are lots of litigations, lots of frauds. There are lots of companies which are going liquidation. We have understood lots of cases wherein the repayment to the banks were not happening. So this is the atmosphere in which we operate today. On the other side, we as professional chartered accountants are subject to lots of reviews. Say if we take the Institute of Chartered Accountants of India, we have the peer review which is done once in every 3 years. We have the QRB review. We have the FRRB review. For listed companies and for certain class of companies, we have the NFRE reviews. So there is a very, very important aspect on quality which needs to be preserved during our audits so that we do a proper audit and we would be able to sustain any kind of reviews that happen on our audit files. So this standard SA220 talks about what would be the auditor's responsibilities with reference to quality control procedures. It also talks about the responsibilities of an engagement quality control reviewer. We will discuss slightly in detail about the responsibilities of these 2 people. And this standard is applicable from 1/4/2010. See, we would have always spoken about SQC1, so which talks about the standard quality requirements. So in case if the SQC1 requirements are applicable to your firm, then we would have already defined certain processes and certain controls in the manner in which we do various things. Say, for example, independence requirements. So we all understand that being independent of the client we serve is very important. So how do we ensure independence? Independence needs to be ensured for the firm, the partners, and the team which serves the client. So you as a firm would have already defined a preset procedures as to how you will ensure independence. Say, for example, you may say that you will have a policy that any client that you do which is listed, none of the partners or the team members should hold stocks in those companies. 2, you may say that each of the members should give an annual declaration stating that they are independent of the clients. 3, you may have a mechanism. Often you may call for the various records of the partners and do an independent inspection. You can call for their income tax returns. You can call for the, what should I say, demat statements. You can call for the bank statements. So these things, by review of these things, you would be able to understand the share transactions or the financial transactions the partners have entered into and ensure that there has not been any act with a partner which could potentially result in an independence issue for the firm. So these processes are at firm level, which should have been already defined with your SQC process. Now come to the next level. The quality is not only at the firm level, but it also needs to be done at the engagement level. So at the engagement level, the engagement partner will be responsible for the overall quality. So he can rely upon the SQC. Say, for example, independence, as I spoke, he can rely upon the SQC of the firm to ensure that the independence requirements are taken care of in the engagement in which he or she is responsible. So why is quality important? We need to ensure that the required professional standards and regulatory and legal requirements are complied with, and the auditor's report that we issue is appropriate in the circumstances. To ensure that these two things are done, it is very important to ensure quality in the audits. So in addition to the various terminologies which are defined in the standard, there are two things which is very important for us to understand. Engagement quality control review and engagement quality control reviewer. Because as I said, the quality which is dealt with in this standard will be done at two stages or three stages. One is the firm level, which is SQC. One is at the engagement level. And we will also be discussing about an independent review which needs to be done to ensure that the engagement quality is being preserved. And that independent review is called EQCR or the Engagement Quality Control Review. It is more applicable for listed companies and for certain class of companies. The certain class of companies can be defined by the firm, which is again part of SQC. So what does this review means? This is a process by which you evaluate before issuing the report or the significant judgments which the engagement team has made and evaluate whether the conclusions they have reached is appropriate in the circumstances for the report that you are going to give. So basically, in a nutshell, what does it mean is that there is going to be an independent review of the work done by you to ensure that the conclusions that you have reached and the opinion that you are going to give is appropriate in the circumstances. So the person who does this EQCR is the engagement control reviewer or EQC reviewer. So he can be a partner, he can be an independent person, he can be an external person, but we need to ensure that he has the necessary quality, the qualifications and experience to perform a review. So what will he do? He will have to independently review things and come to the conclusion that the engagement team has done the necessary things and the report that they are going to issue is appropriate in the circumstances. So when I say experience, say for example, you are doing an NBFC audit. So NBFC, as we all know, it's a regulated industry. There are lots of compliances. In addition to the accounting standards, you also need to comply with the various requirements and circulars and notifications of the RBI. So a person who has not even done an NBFC, if he is going to be appointed as an engagement quality control reviewer, then the whole purpose of having an independent review may not get satisfied. So that is why we need to ensure that the person who is doing this EQCR should be a person of competence with the relevant industry experience and knowledge. So again, who can be the EQCR will be decided by the firm level, but he should be a person who is independent of the audit. So if I as an audit partner have my team, I cannot be the substitute and say I am also the engagement quality control reviewer. I will have a different partner who is not connected with the day-to-day engagement of this audit to be the EQCR. So that is the first requirement to ensure quality as defined on this standard. So as I said, the quality can be done in two stages. One, at the engagement level. So these are certain aspects which at the engagement level, you need to ensure quality. So this would be the responsibility of the engagement partner. The engagement partner needs to ensure that the relevant ethical requirements are complied with. Honesty, integrity, we all know what are all the ethical requirements. The work should be done in line with the requirements of the standards. Say, for example, external confirmations, subsequent events, management representation. So we have a specific auditing standard which talks about the auditor's responsibility on all these cases. So it will be the responsibility of the engagement partner to ensure that all the requirements of the SCS are being taken care when he or she does the audit. We spoke about independence, client and engagement acceptance. So again, this could be probably an SQC1 requirement. If there is a firm policy on how a new client or a new engagement can be accepted. Say, for example, it says that we need to ensure independence, we need to do a background check of the promoters, we need to do an industry comparison, we need to do the Google search to understand about any news article which appears about the company or its directors or its promoters. So what are all the engagement acceptance procedures that you need to do? The audit engagement partner needs to ensure that that is being done. The audit engagement partner will also be responsible for directing his team, supervising his team, determining the nature and extent of procedures to be done. He has to do the review of the work papers. He needs to do and ensure that the reviews are done on a timely basis. Wherever there is a complicated matter, he needs to ensure that there is a proper consultation. Say, for example, your client has lots of derivatives, and we all know that if there is a derivative, there should be a mark to market. So accounting for derivatives itself would be a huge challenge. So the audit engagement partner in this particular case may decide that he or she consults with a particular person who specializes in fair valuation or who specializes in derivative accounting. So there should be an adequate documentation on the kind of consultation you made, with whom, for what. So these are the responsibilities of the audit engagement partner. In addition to this, you not only do these things, we also know the saying that whatever is not documented is not done. So audit engagement partner should ensure that he has a proper documentation for all these aspects. So going back, this standard SA 220 talks about quality, and these are certain aspects on quality which would be the responsibility of the audit engagement partner. Now going into the other aspects of quality, as we said, in case if there is a mandatory requirement or in case if your SQC defines, you will have an engagement quality assurance review for your audit engagement. So what does the engagement quality assurance review person need to do? Again, there are specific requirements for listed companies and certain requirements which are not required for unlisted companies. Certain aspects which he will review as part of the process would be independence. He will run through the consultations. He will have to run through the significant risk that has been identified by the engagement team and the audit procedures that has been done on how you mitigate with this risk. What are the corrected misstatements? What are the uncorrected misstatements? Whether the presence of corrected and uncorrected misstatements would lead you to a circumstance wherein you say that there could be a potential control weakness. So in case if there are control weaknesses, how has the engagement team addressed those things? What has been the materiality used? Whether the materiality used is consistent and whether it's appropriate in the circumstances. What are the aspects on which the management or the audit team has done communication to those charged with governance? In case of listed companies, what are all the key audit matters which are going to be reported? What are all the key estimates in the balance sheet? Provision for debtors, taxation, depreciation, warranties, AS 15 actuarial valuation. So these are certain estimates which you could find in the balance sheet. And the moment we talk about estimates, we know that it is a judgment and there could be a possibility of misstatement. So the engagement quality assurance review also needs to review the estimates and the work done by the audit engagement team on validating those estimates and how they have concluded. He has to take a holistic view. He has to consider all these aspects and then come to an independent conclusion as to whether the opinion which the engagement team proposes to give after doing all the audit is appropriate in the circumstances. So these would be certain aspects which the EQCR reviewer has to do. He has to do a documentation. Generally, what we do is there should be a docket. The EQCR will give you all the comments. The engagement team should respond to those comments, and there has to be an understanding between the engagement team and the EQCR reviewer, and they have to conclude and sign off. Again, the standard also provides, and the SQC of the firm will also provide, in case if there is any disagreement between the engagement quality assurance reviewer and the audit partner, what should be done. So all these processes needs to be completed before the engagement partner issues the report. So this is how an independent person who is not connected with the audit reviews the various aspects which are very critical for the audit and gives a sign off which would enhance the quality of the work which is being performed by the firm. And This is the crux of SA 220. And in certain firms, what is happening is that the entire process is electronically communicated. So there could be a portal, there could be a workflow, the documents flow through the workflow, and the sign off by the EQCR will happen through the system. So any independent reviewer would be able to understand the date of sign off of the EQCR reviewer, the date of sign off of the audit engagement, and see whether all these steps have been done before the actual engagement was signed off. So who is the engagement quality assurance reviewer? How is it being determined? What would be the scope of his work? What would be the documents the engagement team needs to give to the engagement quality assurance reviewer? How does the communication happens between the reviewer and the engagement team? What is the conclusion and what are all the sign-offs? So again, these would be certain documents which the firm has to preserve to prove to any external agency in case of any reviews that a proper engagement quality assurance review has been completed and the requirements of SA 220 has been complied with. So this is a nutshell. So a small standard, but a very important standard, because quality is the base on any work that we do. And the quality is something which needs to be done through the year, across all the engagements, and there cannot be any compromise on the quality. So how the quality needs to be maintained? By having a separate review in addition to the work which is done by the engagement partner is the crux of this particular standard. So each of the audit firms can define their own process in terms of how this will be achieved within the broad framework of SQC1 and this particular standard SA 220. So again, I conclude this standard by stating that this is very important part of any firm's SQC, and there cannot be any compromise, because unless you demonstrate these things having been done, it would be very difficult for the firm to undergo any regulatory reviews. The third standard that we will be dealing with this evening is SA 250. Always we have a confusion as to what is the scope of auditors, whether we are there only to ensure compliance of the accounting standards by complying with the various auditing standards, or how do we ensure compliance of various laws and regulations which would be applicable to our entity. So there is a standard SA 250, and this is applicable from 2009. So when I say various laws and regulations, say take an example of NBFC. So in addition to the accounting standards, in addition to Division 2 of the Schedule 3, where the disclosure of the financial statements is defined, you also need to comply with the various RBI regulations and circulars. So how does the management comply with these things would be based on their internal controls. What would be the responsibility of you as an auditor of that NBFC to ensure compliance of the NBFC related laws and regulations is what is being dealt with in this by standard. When we look at the laws and regulations, it could be broadly divided into two aspects. One, which would probably have a direct impact on the financial statements. Again, going back to the example of NBFC. Say NBFC gives you a manner in which you have to classify the assets as standard, substandard, doubtful, how you have to make provision for it, how you have to comply with, say, a NIM for an MFI, how you should do a provision for these categories of the assets, etc. Yes, there is an overriding provision of India is 109 on how you have to make a provision, but we need to ensure that the provision as per the standard is more than the provision suggested by NBFC. So compliance of this law in reference to provision is going to directly impact the financial statements and the results. So you as an auditor would have more responsibilities on such laws and regulatory framework, which has a direct impact on your financial statements. There could be other laws and regulations which your company has to comply with, but they may not be having a direct impact on your financial statements. Say, for example, compliance with pollution control board. It is very important because unless you comply with the pollution control requirements, there is a risk that they may come and ask you to shut down your factory, the client's factory, not your factory. So this is very important from the management side to ensure compliance. But you as an auditor, it may not have a direct impact from a financial statements perspective, but it could still be important because in case if there is a huge deviation from a pollution control requirement and there is an order to state that the factory needs to be closed, it could still have an impact on you because you would question the going concern of that company. So all the laws and regulations are important, but this standard helps you differentiate between the laws and regulations with specific reference to what would be the duties and responsibilities of you as an auditor. And the main preface of this standard on how this responsibility is fixed depends on the fact on whether it has a material impact on the financial statements or not. All said and done, it is the management's responsibilities and the responsibility of those charged with governance who has to ensure compliance of these laws and regulations. So what would be your responsibility as an auditor? You are not appointed as an auditor to prevent non-compliances or to detect non-compliances, but you need to be skeptic. You need to define procedures. You have to ensure compliances. Wherever you come across any non-compliances, you will have an obligation to do more things, document and report wherever required. So what would be those aspects which is having only an operational impact? It would be very difficult for you to find out because there could be concealment. Whether it is in compliance or not in compliance could be a matter of a legal determination. So you have to be very careful when you get into checking the various compliances. Again, though I'm repeating, it is very important for us to understand the differentiation. Those laws and regulations which could have a direct impact on the financial statements, we would be directly responsible. The more a regulation moves away from the financial statements and disclosures, the probability of we finding out could reduce because the purpose for which we are appointed and do the audit would be completely different from the purpose of ensuring compliance, which is the primary responsibilities of the management. This is what is being dealt with in more detail in this particular slide. What impacts directly the financials? You have to appropriate procedures. You need to inspect documents. You need to talk to the management. You need to get necessary evidences. And wherever you feel any deviation, you need to respond appropriately. And all these audit procedures would come from inspecting the documents and inquiring the management. And wherever required, you also get representations from the management. In case, if it is not directly having an impact, in case if you come across any deviations, we need to take it up with the management and those charged with governance. But we just cannot while away our responsibilities by stating that, no, this does not have any impact on the financials and I am not looking into it. You need to be alert. You need to be professionally skeptic. Based on the understanding of the industry, you probably may know many of the laws and legal aspects which should be complied with the company: pollution control, stop and establishment, PF, ESI, gratuity. So you will be able to list down those acts and laws and regulations which would be applicable to the company based on the understanding of the company, the industry in which it operates. So always have a professional skepticism, be alert to see whether based on your discussions, based on your inspection of documents, based on review of the any minutes of the board meetings, you are able to identify any potential non-compliances. This slide leads from the previous discussion. In case if you are suspicious that there could be any potential non-compliances, we need to dig further. We need to have further understanding. We need to understand the circumstances based on which you feel that there could be a potential non-compliance. Have a discussion with the management. In case if you feel that the management is not coming right forth with the necessary documents or details or explanation, you have to escalate it to those charged with the governance, which could be the board of directors, which could be the audit committee, etc. See the evidences. It could be evidences which you have obtained. It could be the potential evidences which you need, which is not available. Do an overall evaluation on what could be the implication, whether this could have an implication on the risk assessment, whether it could have an implication on the internal controls, whether it could have an implication on the various representations which you have relied upon. Once you come to a conclusion based on these facts, you need to ensure that you have a proper communication with those charged with governance. You also need to evaluate whether these non-compliances, if it has been accepted by the management that yes, it is a non-compliances, whether you have an obligation to report it to any authority. So again, going back to my example of NBFC, there is a requirement that in case if you find out any non-compliances or frauds, you need to report to RBI. The engagement letter which you have in NBFCs will specifically have this clause. And I think even there is a circular or a notification which says that this is also an auditor's responsibility for them to report directly to RBI any circumstances that you would have noticed in the audit of an NBFC. So your responsibility not only closes with your internal discussions or documentation, it expands to the management, it expands to those charged with governance, and if required, it also expands to other authorities if it is a requirement. So in case if you have such non-compliances noticed, we need to have a deliberation internally as to how it could potentially impact your audit opinion. So whether we need to disclose, whether the management is willing to disclose, if the management is not willing to disclose, whether we should have an emphasis of matter, whether we should have another matter paragraph, or if you conclude that it could have a potential impact on the financial statements, which is material, whether we should have a qualified opinion, whether you should have an adverse opinion, or whether you have not been given all the necessary information for you to conclude whether there should be a disclaimer of the opinion. These are certain aspects which you as an auditor need to review before you issue the audit report. So in case if you are not able to conclude on these aspects, whether we would end up disclaiming is also something which you as an auditor has to conclude on. But all these deliberations, you should have adequate documentation in the file, and you should also ensure that you have a proper discussion with the management or those charged with governance. So yeah, small standard, but very important standard, because this spells out the responsibility of you as an auditor when it comes to non-compliances of various laws and regulations. So what does this standard says? Broadly, it defines two things: whether such non-compliances would have a potential impact on the financial statements and disclosures or not. In case if it could have a potential impact on the financial statements, your responsibility increases a lot, because it could probably impact the true and fair opinion that you propose to give on the financial statements. Even in case if it is not having a direct impact on the financial statements, you are still responsible to complete few aspects, though the audit intention is not to find out such non-compliances. If you have a suspicion, the standard talks about what are the further procedures you need to do, what are the documentation you need to do, what are the discussions that you need to have, and how you have to conclude with reference to your audit report. So this is a very important standard because, as I said, under the present regulatory requirements, when there are lots of laws and regulations to which your client could be exposed to. We need to be aware of any potential non-compliances which could impact the financial statements. And we need to follow the guidance of this SA 250 for us to perform the audit with the adequate responsibilities in discharging our duties. So we have covered three standards, SA 210, SA 220, and SA 250. The last standard for discussion, SA 315, which is a very, very important standard again, because this deals with identifying and assessing the risk of material misstatement through understanding of the entity and its environment. When we speak in any discussions of auditing standards, etc., we always talk about certain inherent limitations, because one, we will have limitations as to time. We may have limitations with reference to availability of people. We will not be able to spend months and months together in a client doing the audit, because they need to do certain things and there are reporting obligations. So because of these limitations, we will be doing only test check. It may be very difficult for us to do a 100% audit of all the financial line items. So yes, these are being recognized in the standard, and that's why in the scope we give stating that it's only a moderate assurance. We are not responsible for identifying fraud. Though I have done an audit with all these precautions, there could be certain material misstatements which could not be identified by us. Okay, all those precautions are there. But we also need to demonstrate professional skepticism. So we need to prove with adequate documentation that we have been professionally skeptic in performing the audit in compliance with the various auditing standards. So one of the things which could help us in performing this responsibility within the limitations is to do a risk-based audit. So when I say what a risk-based audit, what does it mean is that we try to identify what could be the risks for that particular entity. So because of this risk, what could be the areas on which there could be potential misstatements? And once we identify this, our time and efforts can be directed towards those areas which would mitigate the risk, by which the potential risk of material misstatements can be minimized to a level wherein you will be able to give a moderate assurance. So when I say a risk-based audit, when I say that I need to understand the various risks, when I need to understand how those risks could have a material potential misstatements, I need to do certain processes. So what should I do? How do I identify the risk? What are all the steps I need to do? How should I identify a potential material misstatements? So those are the aspects which are dealt with in this SA 315. Again, this is a fairly detailed standard. So when you go to the standard, you will have various instances, various examples on how you can identify the risk of material misstatements. Not only the standard deals with the various circumstances, but it also provides you with a listing of what you as an auditor needs to do to identify these potential misstatements. Because once you identify, with our expertise and knowledge, we will be able to define procedures. And once we define procedures, we will do the procedures, we will be able to document it, and we will be able to conclude it stating that there is no risk, and the opinion that we could give could be a moderate assurance. So identification plays a very important role. So what we will do during the course of this discussion is to understand the various sources which can help you in identifying these areas which could have material misstatements. Say, for example, this could be external factors, the company, the industry. We spoke about a lot on NBFC. So the moment we know it is an NBFC, we would be able to identify the various risks which could impact the NBFC industry. It could be company specific. Say, for example, if you are in a chemical manufacturing company, you will know that complying with the various health hazards or complying with various pollution control boards would be very important. If it is a pharma company, if you are going to do exports, we know that we need to comply with various requirements of the US regulatory standard. Food industry would have its own compliance requirements. So, say for example, if it is going to be a power industry, again the various circulars and notifications of the power ministry would be important. So you understand the company specific requirements, which could provide you with various details on which there could be a potential misstatement. People are very important. In case if you feel that the people are not competent enough, then this could result in material misstatements. It is not only the people, it will also be the processes and controls within an organization. Processes and controls will lead you to the information system. So we also need to understand the system which the management use for processing the data, whether it's Tally, whether it's SAP, whether it's Oracle. We also need to understand how the system has been designed. We will talk more about it. So these are all certain sources which is available to you, based on which you would be able to identify whether there could be any potential misstatements. When you do an identification, you will do it at an assertion level, boiled down to the class of transaction or account balances. Again, these terms of assertion, class of transaction, and account balances, we will spend a few minutes in detail in the coming slide. So this risk of material misstatements could identify can arise from either error or a fraud. So we as an auditor need to ensure we have an understanding. So we spoke about understanding the entity and its environment as one of the main source by which we can identify such potential misstatements. So how do we do it? We talk to the management, we perform analytical procedures, we observe, we inspect the documents, etc. When I say analytical procedures, say for example, we can do a comparison between two companies on similar industry of the various financial data, which could probably provide you with any deviations which you notice. Why is important to understand the industry? Say for example, if you are doing an audit of an automobile company, so steel would be one of the important raw materials. So we can get an understanding in terms of how the steel prices has moved during the year. An increase in steel price could probably mean an increase in cost of materials for production. We understand that there were issues in having semiconductors last year, so that could have impacted the production. A couple of years ago, we had a switch over from BS4 to BS6, so that could have an impact on the sales, that could have an impact on your closing inventory. So understanding the environment and the business would be very important when it comes to risk assessment. So how you do? Identify the risk by understanding the entity, understand the controls within the organization. You would have used the term risk control matrix a lot of times. So what is risk control matrix? We understand the various classes of transactions, the account balances, what could go wrong. And once we identify what could go wrong, we also understand the controls within the organization on how they prevent this from happening. So we need to have a thorough understanding of the entity's processes and controls. We also need to understand how this could impact the financial statements, whether it would impact a particular line item or whether it could impact and have a pervasive impact on the financial statements. Say for example, estimates. So if you have a risk stating that there could be certain bias in the manner in which the estimates are being made by the management, then this could probably impact various line items in the financial statements. When I say bias, The example is you find out stating that the management was always conservative in making the estimate. So there is a difference, which is always that the estimate you have is more than the estimate made by the management. So when I say that this could have a pervasive impact, because the estimates could hit various line item of the financial statements: depreciation, taxation, warranty, provision for inventories, provision for receivables, provision for employee benefits, provision for sales return, provision for impairment. So in case if you have a potential risk that there could be a bias on the estimate, this could be more pervasive and not linked to one particular account balance. So the more pervasive it is, the more risk you as an auditor have, because it could result in a potential material misstatement across any aspect of the financial statements rather than any particular line item. So it is very important for you to understand at the time of risk assessment on the class of transactions or the account balance it could relate to. How could I get an understanding? You understand the industry, you understand the regulation, you understand the external factors, you understand the financial reporting framework. Say, for example, when Ind AS becomes mandatory for your company, then this could be a potential risk of material misstatement, because there are lots of aspects which you need to consider in an Ind AS financials as compared to your normal IGAAP: derivatives, mark to market, fair valuations. So these are the things which are very mandatory in India's financial statements, which could result in a potential misstatement. Going concern: how is the geographic spread of the company? Whether they have any cross-border investments. The moment you say cross-border investments, there could be a risk on compliances of not only the regulatory requirements in India, but also abroad. This could also result in certain impact on, say, for example, under the present circumstance, if you deal with more customers or more suppliers in Russia or Ukraine, it could have a serious impact on your business. You may not be able to sell, you may not be able to buy, you may not be able to transfer funds. So how does this present Ukraine Russia war impacts your company is very important external factor that you need to understand. What are the investments? What is the structure? In case if you have a very complicated structure wherein you are not able to identify who are the real owners or who are the real promoters, it could have a risk. How do you finance the company? Equity, debt. What are all the debt instruments? What are the terms and conditions of the debt? Say, for example, if you have so many convertible instruments, so many redeemable instruments, then again, this could have an impact on the statements in terms of disclosures or valuations, etc. Accounting policies, how does it compare it with the peers? Again, when we talk about Ind AS, there are various options available: cost model, fair valuation model, etc. Revaluations. So what do you choose? What is the normal industry practice? Is the accounting policy that your entity follows is more aggressive as compared to what generally your competitors follow? What are the pressures of the management? Listing, stocks, bonuses, the employment agreement with key managerial personnel. So these things could play a vital role, because to meet these requirements, there could be a potential misstatements to the financial statements. If there is a new PE investment which has happened, there could be a result on, there could be a compulsion on results. So because of this, there could be a potential misstatement. So these are all certain aspects: the internal circumstances and the external circumstances, the internal evidences and the external evidences, which you should consider in doing a proper risk assessment. I can just keep going on. Business, say for example, auto industry. We spoke about challenges of raw materials, challenges of materials, challenges of compliances. Marketing channel, whether you sell it directly to the customer or whether you sell it through dealers. How is the management? How far is the delegation of authorities? Whether you depend on outsourcing. Say, for example, if you have service organization who does most of your accounting, we not only need to understand the controls within the organization, but you also need to understand the controls around how the data is given to the service organization for them to process the data. How is the data sent? How do they maintain the confidentiality? How do you review that the entries made by the service organization is correct? Who are your customers? Is there over dependency on any customer? How is the credit policy? If you're very lenient under the COVID situation, wherein you give excess credit days, whether there is any potential bad debts that is sitting there in the financial statements. Related party transactions, we have dealt a lot in various standards on why this is important and what kind of audit procedures that you need to do. So understanding the business in much detail would be a very important step for you to understand what could be the ROMs which could result in a potential misstatement. How do you understand this? We spoke about client acceptance procedures. We spoke about the management search. Say, for example, if you have already done some limited reviews for a listed company, the information that you got when performing the limited review at the time of final audit could be very relevant. Limited review, you could have done various variance analysis. In case if you find any huge deviations in the variances as compared to the previous period, is there any potential misstatement? Again, you will not be able to conclude yes, there is a misstatement by doing these procedures, but this would give you indications, and these indications are very important for you to plan your audit. If it is a listed company, you can look at the presentation made to the investors, the investor calls that they have, the press releases that is going to be released after every quarter. You understand the controls not only at the financial statement level or the transaction level, you also understand the controls at the organization level. What is the tone at the top? So these would be certain source of information which you as an engagement team can discuss amongst yourself to identify ROMs, which is very important. Industry factors, we have spoken a lot. Compliances are regulatory industries. Whether you are in an industry wherein you are an aggregator, say Ola or Uber, wherein you don't own any car, but you do crores and crores of business. So understanding the industry would also play a very important role in understanding the ROMs which would be applicable to that industry. Spoken a lot on regulatory compliances, power sector, pharma, non-banking regulations, etc. So understanding this regulatory environment and the compliances that you need to do for that specific regulations will also lead you to any potential ROMs which you need to consider. Changes. This is not a constant world. There could be changes. There could be changes in the industry. There could be changes in the business. There could be changes in the organization structure. There could be changes in the manner in which you distribute. There could be changes in compliances of the accounting standards and auditing standards. There could be changes in your IT system. How does this changes impact you? If I take one example, say for example, Ind AS 116. For an Ind AS company, when 116 became mandatory, it could have a huge impact on your balance sheet because the various retail agreements for spaces, which was an off-balance sheet item as a commitment under the old Ind AS 17, would probably now become a on-balance sheet item because you need to account for the right of use and the corresponding lease liability. So when you looked at the balance sheets of Shoppers Stop or Indigo after Ind AS 116 became mandatory, you would have seen a significant increase in the assets and liabilities because of accounting. So this accounting could lead to a potential misstatement which you should be aware of. So any change in any of these aspects would also be another source for you to identify ROMs. In addition to relying on the various external evidences, You also need to talk to the management. You talk to those charged with governance. You talk to them to see whether there are any frauds, whether they have identified any frauds. What are all the control mechanisms that they have to prevent frauds? What are all the control mechanisms they have to ensure a proper reporting, which will be without any potential misstatements? Because all said and done, it is the management's responsibility to ensure that the financial statements that they give for audit and they submit is without any material misstatements. So how does the communication happens with those employees? So these are certain ongoing discussions that you should have with the management and the audit committee and those charged with governance to identify two things: what they do to identify wrongs, what they do to prevent any misstatements, and from this, if you get any lead, say for example, if you have identified that there is a new related party transaction, so you need to understand why is it a related party, how did they arrive at the arm's length, why it has to be given to a related party, and why it cannot be given to a third party. Say for example, in one of my recent clients wherein they are going to deal with radars, they have to import many of these things only from their group company. So they gave me a justification as to one, why they need to import, two, why an alternate source is not available in India, and they also gave me a comparison as to the rates wherever there were alternatives possible. Because in most of the cases, they were not able to have an alternative which would satisfy the requirements of the agencies. So they concluded that doing these transactions as a related party transaction is mandatorily required. So you have these discussions. Unless you have these discussions, you will not be able to understand the business rationale of such transactions. IT system is also very important. The more the organization grows, the more complicated it becomes. It would be very difficult to have controls manually. So you will be, meaning the client would be having more and more dependence on the IT system. So when you do the audit, traditionally, probably we would have done vouching, seen the vouchers, seen the BRS, etc. But under the new circumstances, unless we have an understanding of the IT system, unless we understand how the controls are defined within the IT system, unless we understand how the processing happens within an IT system, unless we understand the IT architecture, because there could be multiple systems which are being used and there could be a lots of interface between these systems. So we need to have a proper understanding of this system, because the understanding would give you to lead you to control weaknesses which could be there. And once you identify any potential control weaknesses, you can understand the mitigating steps. So going back to the discussion which we had slightly earlier, you as a chartered accountant may not be able to understand this in full. So as part of your audit team, you may also consider having an information technology specialist who will be able to understand these things, do the required documentation, do the required testing, and give it to you. So though you have an IT person who is a specialist as part of the audit, going back to the discussion we had on quality, you as an audit partner will be responsible for the final decision. You can take any consultation, you can take any help, but ultimately you as an audit partner will have to take the judgment and issue the audit opinion. So understanding risk assessment process by talking to the management, we already had a discussion. So when I say ROMs, we also need to understand assertions, because you just don't say that there is a potential risk of misstatement. You also need to narrow it down to the potential class of transaction or the account balance to which it could relate to. So what are all the various assertions from a class of transaction? We need to look at occurrence, completeness, accuracy, cutoff, and classification. So these would be the assertions for class of transactions where you would be relating the ROMs to, whether it has been entered in the correct period, whether all the transactions has been entered into, whether the transactions has been accounted at the correct rate. So whether it's a capital expenditure or a revenue expenditure. So these are all the ROMs which you will be able to relate to class of transactions. What are the assertions for balance sheet items? Existence, rights and obligations, completeness and valuation. And from a presentation and disclosure, it will be occurrence, rights and obligations, completeness, classification and understandability, and accuracy and valuation. So you as an auditor, it is not only important for you to identify the ROM, but you also need to map the ROM to any of these assertions. Because unless you do this mapping, you will not be able to perform procedures which will mitigate the ROM that has been identified. So there could be few things which you will not be able to relate to any potential class of transactions, but under most of the circumstances, you will be able to relate a ROM to any of these assertions, and you need to design audit procedures to address this risk. Always we concentrate on risk which is material or significant. So generally under auditing standard parlance, we would have heard that it is a significant risk or a normal risk. So again, we identify ROMs to see whether it would be a significant risk or a normal risk. Anything relating to revenue or anything relating to management override, we always state that it could be a significant risk because the impact that particular misstatement would have on the financial statements would be very material. So how do we identify whether it's a potential and a significant risk? You understand the nature of transaction, you identify the significance of the transaction to the overall financial statements, you understand the complexity of the transactions, you understand the amount of judgment. Say, for example, if it is going to be a goodwill impairment analysis or a impairment analysis of a property, plant and equipment, the various assumptions which goes into this analysis would be very complicated, because probably you will start off by looking at the future P&L and the potential cash flows. That itself is a judgment. Then you will do industry comparison. Then you will do a discount rate. Then you will do something as a terminal rate. Each and every number which is being used for analysis of any potential impairment on property, plant and equipment or goodwill will be based on an estimate. So the more the estimate, the more complex it is, the risk of material misstatement is higher. So you need to have a more proper understanding. Again, going back to the earlier discussions, this is something which you may or may not be able to do. And so you may have a consultant who is a specialist in fair valuation or a valuation or understanding the future financials to be part of your engagement team to do an analysis of this spreadsheet given by the management to conclude whether it's logical and reasonable. It is not only important for you to understand the risk of material misstatements, you also need to understand what controls the management has put to mitigate those risks. So this is how your entire ICFR process would work, as you would know. We understand the class of transactions, we understand what could go wrong, we understand the potential errors, we understand the account balances, and then we see what controls the management has put to mitigate those risks. And then we test those controls after doing a walkthrough and concluding that the manner in which such controls has been designed properly. Meaning, we see whether that particular control has been designed in a manner that it would address the potential statement to which it has been designed to. So unless we have a comfort on the design, we don't go into testing the operating effectiveness. So understanding the controls plays a very vital role when it comes to risk of material misstatements. When we say controls, it has to be relevant control, because we need to pinpoint the potential error and the class of transaction And we as an auditor would be interested in understanding that particular control, which is more related to the particular error which we are trying to test or mitigate. So how do we know whether the particular control is relevant? We look at various factors like materiality, the significance, the size of the entity, the size of the organization, whether it's a manual control or an automated control. So again, a judgment plays a very vital role. Again, right through the audit, you need to take various judgment calls. And it is very important that those judgment calls are adequately documented, because if you are subject to any review, you need to substantiate with documentation that you have been professionally skeptic and there has been no gross negligence in you performing your duties. So documentation plays a very vital role. So when I say control, we would have done all these things when we do an ICAI for audit. We understand the control environment, we understand the person who does the control, we understand the competence of the persons. We also understand how the audit committee or those charged with governance helps in ensuring that these controls are in place and are being followed right through the year. So we understand the management philosophy, the organizational structure, the roles and responsibilities, the authorities and responsibilities, the segregation of duties, etc., to identify that relevant control which would address the wrong that you have identified during the audit. So understand the control activities. So what does it do? So how do we do it? We either inspect or we reperform or we have a discussion with the management, etc. For example, if it is BRS, we could probably do a recomputation of the BRS. If it is a provision for doubtful debts based on aging, we can do a recomputation. Or if you say that there has to be a preparer, there has to be a reviewer, you can look at the documents or the online controls wherein you see two different people, one authorizing and one approving, or one generating and one approving. So you have an understanding of these control activities which is being done by the management, because when you want to test the controls for mitigating the wrong, you can't invent something and say, no, I will only do this and see whether the wrongs are addressed. You need to test those controls which are prevalent in your organization, and you will not be able to do this unless you have a clear understanding of the control activities which is being decided by the organization. And then you test the controls. How do you test the controls? As we already discussed, if it is going to be an automated control which is defined by the computer environment which is there in the organization, you probably test the controls using the computer specialist. If it is manual control, you do the controls testing by yourself. You investigate, you reperform, you see the documents, or you see a transaction being posted live. You can do any of these procedures depending on the nature of control that you are being testing. Again, we have an institute guidance note which has a very detailed analysis as to how you do those things, right from assertions, right from control activity, right from control description, right from testing, right to the manner in which you need to document, right to the number of samples that you need to test is all available in the guidance note. And you perform those procedures to ensure that we identify those controls which could probably address the wrongs that you have identified during the audit. And the number of samples will define by the frequency. The more frequent it is, the more number of samples that you need to perform. And as I said, the most important thing is that it should have a proper documentation. All these aspects that I have discussed, not only in SA 315, but also on other standards, it is very critical and vital for us to do an adequate documentation. So in nutshell, SA 315 is a very important standard because we need to have quality in audit. We have inherent limitations. So we need to do focused audit. So where to focus? We need to identify what could be the potential risk of material misstatements or wrongs. So the moment we identify what could be the various wrongs, then we will be able to identify what could be the procedures that we will do or what would be the testing that we will do to mitigate those wrongs. So we had a discussion which is done as per SA 315, which provides you various inputs for you to navigate through this process, right from understanding the external environment and the internal environment, right from understanding the control activity to the control environment to the IT systems. The standard provides you in detail the sources, what you should do, how you should do, and how things needs to get documented. So once you complete this process, you will be able to say that this is the manner in which I have identified wrongs. Because of these wrongs, these are all the potential classes of transactions which is getting impacted, or whether it is a pervasive impact. This is the control environment in the organization. These are all the control activities in the organization. This is my relevant control activity. This is how I would test that control activity, and this is how I would conclude. So the whole cycle is getting done. And once you say that all the wrongs has been properly mitigated, you will be able to take an overall conclusion in the audit that there is no material misstatement on the financial statements, and you will be able to give the moderate assurance to the stakeholders and the users of the financial statements. So that's how the entire cycle works. You start with your obligation, and for completing your obligation, you do various things and come to a conclusion. So should I do this for all the entities? The answer is yes. But for larger entities, you may have larger things to do. But in case of smaller entities, you may not have significant segregation of duties. Most of the things would have been probably done by the promoter. So again, for smaller entities, you need to do these things, but the level and scale can probably be at a slightly lower level, because the controls could get probably concentrated at one person level or the promoter level. So you need to understand what he does, how he does, and probably test it. So just because the entity that you audit is a smaller entity, it does not mean that you will not do a risk assessment, but you will probably do a risk assessment at a level which is suitable to the entity that you audit. So this is in summary from me about the 4 standards. So I thank the Institute for giving me this opportunity. We covered 4 standards, 210, 220, 250, and 315. We started the discussion with engagement in terms of engagement. We then understood the engagement quality control reviews. We then took it to the auditor's responsibility on the various compliances, and we concluded on a slightly detailed discussion on ROMs, significant risk, how we identify, and what we need to do to mitigate those controls. So we have about 10-15 minutes time. So in case if you have any questions or thoughts or suggestions, I will be more than happy to take it. Organizers,
Yes,
you
sir.
can let me know in case if
Sir, am I audible, sir?
any of the participants would like to ask any questions, and probably unmute their line so that they can ask the questions. Thanks a lot, and I'll wait for any questions from the audience.
Yes, sir. They can unmute and ask. Sir, am I audible, sir? Hello.
Audience or organizers, any questions?
Sir, am I audible? Hello. Sir, am I audible, sir? Hello, sir. Raman sir, am I audible, sir?
Hello?
Sir, am I audible?
Yeah, you're audible now. Please go ahead.
Thank you so much for your time, sir. And there's one question in chat. I hope that was covered. Is engagement letter relevant to internal audit? I hope this was covered, sir. Is it, sir? The question that came up in due courses is engagement letter relevant to internal audit?
Yes, sir, because irrespective of the kind of engagement that you give, it's very important for us to understand the terms and conditions, the responsibilities. So for internal audits, for valuation, for due diligence, we have seen the practice of having engagement letters. The content, the structure could be different from what has been suggested in SA 210, but it could be of importance to have it in writing for any kind of engagement so that there is a clarity between you and your client as to what is your roles and responsibilities. So I would suggest that we have an engagement letter for any kind of service that we as professionals provide to our clients.
That was one question, sir. And we'll check with audience if there is any question they can unmute and ask. If not so, if there are any question they can post to SIRC email ID. We'll take up the question in a due course time. So thank you so much for your time spent here, sir. And on behalf of SIRC Chairman, Secretary, Office Bearers in the absence here, thank you so much for time spent here, sir. We look forward to have you in a future session as a physical mode also, sir.
Oh, okay. Thanks
Yes.
again. It was nice interacting with the audience. I will start my presentation in PDF for
Yes, sir.
circulation.
It's already shared with us in a
No,
PPT,
don't
right?
do that. No, don't do that
We won't
because
circulate it as a PPT file, so we'll convert it to PDF and we'll circulate to the
no,
audience.
sir,
Or else
that
if you have
has
any
some of
separate file, yeah.
no, sir, that has some of my working notes. So probably
Okay.
I will send a file in PDF.
Yes, yes.
Deletes my working notes so that it can be circulated to the audience.
Okay.
And
Okay.
SIRC team, in case if you have any questions that reaches to you by
Yeah, I'll
email,
share it to
please
your mail, sir.
share it
Yeah.
with us, and I will be happy to answer it. And
Sure.
I'll always be available for any further opportunities to address this
Sure,
audience.
sure, sir.
And
We look
please
forward to
feel
have
free.
you in future sessions as a speaker, as in physical mode or as in virtual mode. Never time. Thank
Thank
you
you
for
very
your
much, sir.
excellent time, sir. Thank you.
Yeah. Have a nice evening, everybody, and thanks for your patient hearing.
Thank you, sir.